Alright guys, in the last video we had discussed the moving averages. I wanted to add a couple more things about moving averages before we move to the next indicator, which is the Fibonacci retracements. So one thing I had mentioned about the exponential moving averages and how they give more importance to the recent price action. Just because of this minor difference that they have from simple moving averages, usually EMAs or exponential moving averages are more effective on the smaller time frames. So if you're scalping, EMAs are preferred. On the larger time frames, it does not really matter. It doesn't make much of a difference. So that's one thing. The second thing I wanted to add is that moving averages work quite well in trending environments, but in a ranging or consolidation environment, they don't work that well because most of the times they will just be flattened out. And if you're entering or exiting based on them, you might get chopped quite a bit. The last thing I wanted to say is that moving averages do not tell you when the reversal might happen. So they will keep you in a trend as long as it's going up, and then they will take you out of the trade once the reversal has already happened. Unlike RSI, where a divergence can warn you about a potential reversal, moving average cannot do that. If price is far away from a moving average, then maybe you can expect some form of consolidation or reversal. But overall, moving averages do not tell you when a reversal might happen. So now that behind us, let's move to Fibonacci retracements. So Fibonacci retracement, this concept comes from the idea that we see Fibonacci numbers or Fibonacci patterns almost every single place in the universe. If you don't know what Fibonacci numbers are, Google it a bit, learn about them because they appear everywhere in the universe. From the shape of the galaxies to human bodies and what we find attractive, and sea animals, the shape of the leaves, almost every single thing, Fibonacci numbers are noticed. This makes market participants assume that Fibonacci numbers also matter in the markets. Now, whether that's true or not, I'm not going to debate that. They obviously don't work 100% of the times like anything else in the markets. What I can show you is how Fibonacci numbers are used, or at least how I would think of them, and then you can decide for yourself if those are for you or not. So on TradingView, if you go here, we'll have this idea called Fibonacci retracement. There's other ones too called trend-based Fibonacci extensions. Extensions are used to predict where the price might go next. But let's use retracement for now. So a retracement is usually used in a trend environment to see, let's say we are in an uptrend. So in that case, you would use retracement to see where the higher low might be made. That's where you would add to your position, or that's where, let's say, you would put your stop, something along those lines. So in this case, we are in a downtrend in Apple, and I will try and use this here. So we made these highs in August for Apple, and then we pulled back all the way to these lows. And then we start to move up again. So where would you expect price to find resistance? You would expect price to find resistance at these important Fibonacci levels. Now the most important ones, there are many numbers here, but the most important ones are the ones that I use are 0.382, 0.5, and 0.618. If a trend is strong, you would find the retracement only happen to around the 0.38 level. So let's say we're in this downtrend, we make this big move, then price starts to pull back up a bit. Where should it create a lower high? If a trend is strong, it would be around this area, 0.382, and then it rejects from there and starts moving lower again. If the trend is still strong, but the strength is starting to weaken a bit, it will move all the way to the 0.5 area, which is a 50% retracement of the entire move. And that's where it will create a lower high and start moving back lower again. And if the trend if it goes all the way to 0.618, you have to start assuming that the trend is weaker and we might be moving to a consolidation phase soon. So in this case, in Apple, we had this swing high, we had the swing low, and then we start to go up. So where should we expect price to find resistance? We should expect price to find resistance as these levels. So 0.382. It found some resistance around this area, pulled back, then moved up again and found real resistance around 0.5. From where it pulled back quite a bit. Now it could not make new lows, so at this point the trend is over. But you guys get this idea on how we can use these levels to figure out where price would find resistance in a retracement. Now this is a downtrend, so that's why we are saying resistance. If it was an uptrend, you would look at supports. So another example, so that's how Fibonacci retracements are used. It's a retracement, it's a counter move to the current trend we are in. That's why it's called a retracement. So that's one example. What you would use that is, let's say price retraced to these levels, you will either add to your position if you are a trend trader, or you would maybe put your stop right above this level, because if it doesn't find resistance here, it can move to the next level and so on. So that's how it's commonly used. Let's look at some more examples. So price went up from swing low to swing high here. If we have started a new uptrend, right, where should we find some support? Now in this case, let's say we are trading, we simply went from here to here, right? Maybe I should not use an example on this small of a time frame. Let's look at something bigger. All right. So let's say price went from this swing low to the swing high and starts to pull back. Where can I expect for the higher low to be made, or where could I add to this position? You would expect that to happen around the 0.38 or 0.5 level. You can see 0.5 level coincided with the support zone and price lift up after that. So hope you're starting to get, right, like in a trend, how you will use retracements to figure out where you can add to your position or where your stop should be. That's how they're mostly used. Then we have something called Fibonacci extensions. So let's say you had this move from the swing lows to swing highs. You pulled back, you found support here. Where should it go next? You would use extensions for that. That's where we have the trend-based Fib extension. So this is the basic concept behind Fibonacci retracements and extensions. Play around with this indicator a bit. See if it helps your system or not. I personally don't use them quite a bit unless we are in an area where price has no previous history. So let's say if we are in all-time highs territory, then I might use Fibonacci extensions to figure out where price might find resistance. But overall, it's not an indicator I use. Also, I know Fib followers are crazy about this indicator, but markets are not perfect like nature, and there are usually variations around the Fib levels, the Fibonacci levels. So if you coincide the Fibonacci levels with some form of zone, it usually works better. That's about it. That's about it for Fibonacci retracements and extensions. If you guys have any questions, ask them in the chat and we'll discuss more.